You've probably heard the phrase, buy the dip, tossed around whenever the stock market takes a tumble. It sounds simple, but in reality, when you see red numbers and headlines warning of market crashes, it's much harder to put your money to work. The fear of further losses can make even seasoned investors hesitate. But here's the thing, some of the best investment opportunities appear when everyone else is panicking. Instead of letting fear drive your decisions, imagine using these downturns to your advantage. What if you could buy shares of great companies at a discount and actually get paid to wait for the market to recover? That's the power of investing in high-quality dividend stocks during a downturn. Today, we're diving into the strategy of buying top-tier dividend stocks when the market drops. These aren't just any stocks, they're companies with a proven track record of rewarding shareholders even in tough times. We're not talking about chasing risky plays or speculative bets that could leave you with big losses. Instead, we're focusing on stability and long-term growth. Think about companies so established, they've managed to raise their dividends year after year, for decades. These are the kinds of businesses Warren Buffett himself loves to own. They sell products people use every day, no matter what the market is doing. When their stock prices dip, you're able to buy the same quality companies for less money, and you lock in a higher dividend yield. That means more cash in your pocket while you wait for the market to bounce back. In this chapter, I'll break down two industry titans with incredible dividend histories and explain why a market dip is the perfect time to buy or add to your position. These are companies you can feel confident holding for the long haul. So, let's jump right in and take a closer look at the first rock-solid dividend stock you should have on your radar. First up, Johnson & Johnson, ticker symbol J&J. This isn't just any company, it's a global healthcare powerhouse with a legacy that stretches back more than 135 years. From humble beginnings, J&J has grown into a household name, touching lives in nearly every country on the planet. Sure, they've made headlines for legal challenges and settlements, but it's important to look beyond the noise. Their core business, delivering life-saving medicines, medical devices, and consumer health products, remains incredibly robust and reliable, even when the news cycle gets rough. J&J operates across two major segments, pharmaceuticals and medtech. Their innovative drugs treat everything from cancer to autoimmune diseases, while their medical devices are used in hospitals and clinics worldwide. This broad reach means they're essential to both patients and healthcare professionals. This diversification is a huge advantage. It keeps their cash flow steady and predictable, even during economic downturns or industry disruptions. When one area faces challenges, another often picks up the slack, helping J&J weather storms that might sink less diversified companies. That's why they're a dividend king, one of a rare group of companies that have increased their dividend payouts for over 50 consecutive years. Through recessions, market crashes, and even global pandemics, J&J has rewarded shareholders with growing income. When J&J's stock price dips, it's not a sign of a broken business. Instead, it's often a temporary reaction to headlines or market sentiment. The underlying fundamentals remain strong, making these dips potential opportunities for long-term investors. Buying during these dips means you get more shares for your money, and your dividend yield goes up. Over time, reinvesting those dividends can really accelerate your wealth building, especially with a company as stable as J&J. Their recent spin-off of Kenvue, the consumer health division, allows J&J to sharpen its focus on higher-growth pharmaceutical and medtech markets. This strategic move could unlock even more value for shareholders and potentially lead to faster dividend growth in the future. With a fortress-like balance sheet, an elite AA credit rating, and a proven track record of resilience, J&J is built to withstand almost any economic storm. Few companies can match this level of financial strength and consistency. Buying J&J on a dip isn't about trying to time the market perfectly. It's about recognizing lasting value and owning a piece of a business that's likely to keep growing and rewarding shareholders for decades to come. This is the definition of a sleep-well-at-night stock. With J&J, you can invest with confidence, knowing you're getting steady dividends and long-term growth, all while helping improve global health. Next up, we have Procter & Gamble, ticker symbol PG, often called the king of consumer staples. This is a company whose products are so deeply woven into our daily routines, you probably use them without even realizing it. From the moment you wake up and brush your teeth, to doing laundry, or caring for your family, PG's brands are everywhere. Their household names, Tide, Crest, Pampers, Gillette, are not just products, but essentials that millions rely on every single day. This constant demand means that regardless of whether the economy is booming or in a downturn, people still need to buy these basics. Procter & Gamble has an incredible track record. They've paid dividends for over 130 years, and have increased those dividends for 68 consecutive years. That's a level of consistency and reliability that's almost unmatched in the business world. Their massive scale and the strength of their brands translate into stable sales, strong profit margins, and a steady stream of cash flow. This financial stability allows them to keep investing in their business and rewarding shareholders. When PG's stock price dips, it's not just a blip, it's a rare opportunity to buy into one of the world's most stable and resilient companies at a discount, and to lock in a higher dividend yield for the long term. What sets PG apart is its relentless focus on innovation and its vast global reach. The company is constantly developing new products and improving existing ones, ensuring it stays ahead of competitors and adapts to changing consumer needs worldwide. Even during periods of high inflation, Procter & Gamble's pricing power allows it to protect its profits. They can pass on higher costs to consumers thanks to the trust and loyalty their brands have built over decades. So, when you see a dip in PG's price, consider it a rare chance to add a foundational, blue-chip stock to your portfolio, one that's built to weather economic storms and deliver steady returns. For anyone building a conservative dividend growth portfolio, Procter & Gamble is a must-have cornerstone, offering stability, growth, and peace of mind for the long haul. So, there you have it. Johnson & Johnson and Procter & Gamble, two pillars of a stable income-generating portfolio. Buying these on a dip isn't about quick riches, it's about building wealth with world-class assets. Always do your own research and make sure any investment fits your goals. If you found this helpful, hit like and subscribe for more smart investing strategies. Thanks for watching. I'll see you in the next video.